Hey everyone, it's Cullen Hilkene with Calisade with our recap of the week that was and laying foundation for the week that lies ahead. Today is Sunday, June the 1st, 2025. So let's get into it. Last week, the market continued an upward climb, albeit more of a grinding one. Early in the week, we saw some positive economic indicators with the labor market continuing to be robust despite a slight uptick. Initial jobless claims rose to 240,000 for the week ending May 24th, which is in line more or less with historic norms and indicates continued employment strength. That obviously came out of April, so we saw an improving trend there. And then lastly, the GDP did contract by 0.2% in the first quarter of 2025. That was primarily due to a surge of imports due to the anticipated tariffs. Now, we do view that front loading of activity to be a cause for concern later in the year. It's not coming through in a lot of earnings reports, not a lot of companies explicitly stating that they believe that they saw any kind of front loading. I think there's a handful of reasons why they might say that. Number one being they can't predict the future, and number two, attempting to do so may not necessarily put them in the best standing with our present administration. So recognizing all of that, whether it's the way they really feel or the way that they are tactically feeling, because it doesn't benefit them to say anything to the contrary, that is where we stand. In addition to those economic numbers, we did see some compelling earnings reports. NVIDIA reported quarter one revenue of $44 billion, which surpassed expectations. Obviously, they experienced certain export control restrictions to China, which may have tempered their performance a bit, and nevertheless still managed to turn in a strong quarter, which has allowed for their stock to continue upwards. Salesforce is another notable name. It exceeded first quarter expectations with an adjusted EPS of $2.58 and revenue of $9.83 billion, raising its fiscal 2026 outlook on strong AI product demand. Costco was a fly in the ointment on some level. It missed first quarter EPS estimates, reporting $4.25 a share, which was a 12.43% increase year over year. However, that was less than expectations. The miss was attributed to rising input costs, tied on some level to the trade war and rising tariffs that are just beginning to trickle through there, although really shouldn't have meaningfully impacted those Q1 figures. But more than anything, cautious consumer spending in anticipation of what might be to come. Again, that's pretty speculative when you think about first quarter and the fact that tariffs really weren't announced until the beginning of the second quarter, but the kind of ominous tone that tariffs were coming certainly came through in February, which is why we saw a decline from February 14th straight through to April 2nd when the tariffs came out, and then a precipitous dive right after that. Looking ahead to this week that is to come. So when it comes to economic data, we see construction spending coming out tomorrow on Monday, factory orders on Tuesday, the Beige Book release, which gives a inside view on the Fed minutes and what was discussed in the last meeting. And then we get initial jobless claims on Thursday, June 5th, and then the May employment report on Friday, June 6th. Notable earnings reports come from Broadcom on Tuesday, CrowdStrike and Guidewire Software on Wednesday, Dollar Tree on Thursday, along with Lululemon. And then on Friday, we get NEO and Hewlett-Packard Enterprise. While optimism continues to drive market gains and hope springs eternal that we're going to get some good outcomes from these trade negotiations, we are entering into pretty pricey territory here. And at least at Calisade, we do harbor some concerns that we're in a period right now where hard data and indicating any adverse impact from tariffs is not yet going to materialize, but we may start hearing some of the soft data, more of the kind of commentary from stores, commentary from companies like, for instance, Walmart, and we expect others to follow, saying that we cannot eat the entirety of these tariff costs. They're going to pass through to consumers. That's, double-edged sword there, because if they aren't eating them, obviously it's going to impact consumer spending because the prices are going up. If they do eat them, it's going to impact earnings. Either way, those kind of comments crystallizing in the weeks ahead may be cause for this rally to peter out a little bit. So we would just tell you to keep an eye out for that. The market, from a technical standpoint, wants to grind higher, but certainly if there is a precipitating event that it can't deny, we can see that momentum turn the other way quite quickly. And while we don't see reason to retest the bottoms without really big news that makes it seem like things are going back to the sorts of conditions that we heard back on April 2nd when tariffs were announced, we nevertheless do think that we're in a little bit of a frothy zone here. And while the probabilities land with grinding higher for some period longer, just watch out that some headlines could cross the line and could end up creating a little bit of selling pressure in the market. All right, those are our thoughts heading into next week. Thanks for watching.